All right, very good. Appreciate it. Thank you so much, Michael. To follow on the conversation that we just had on real estate and inflation, obviously, real estate is an interesting asset class, especially when you're talking about inflation. But one of the other big asset classes that a lot of advisors use in portfolios is fixed income. And fixed income has been in a bull market now for the better part of 20, 30 years. Many people's career. We're starting to talk about inflation now, and that's not a topic that's really come up in discussion, serious discussion, really since the 70s. And how do we approach that when so many fixed income managers have not really experienced bouts of inflation? And what do we do in an environment where the Fed and central banks around the world are involved in the markets? So we've got a variety of topics that we want to hit on, trying to give all those that are on the call an idea of what can be done in a fixed income portfolio. What things should you be looking at in order to preserve assets? Because really that's the fixed income's role in a portfolio, is to provide a ballast, if you will, or certainly an anchor to what is going on in the rest of the portfolio. Especially on the equity side. So with that said, to use a little baseball analogy, we got to introduce the players. And so I'll allow the players to introduce themselves and kind of give a little bit of background so that everybody understands who and where they come in and how they take a look at the markets and their backgrounds. So Stephen, I'd like to start with you, and if you could take a little bit and give us all your background in the fixed income area.
Stephen, you got to unmute yourself. You're muted, so you got to unmute yourself.
Hi.
There you go. There you go.
Thank you. Sorry about that.
So we can hear you.
So, okay. All right, Steve, if you can give us just a quick background for us.
Yeah, sure. Thank you very much, Paul, for attending. My name's Stephen Groslin. I'm a partner at ASG Capital. We're specialized in fixed income products with a focus on subordinated debt. We have two flagship funds. One operating out of Europe, which is a conservatively balanced portfolio, looking to generate between 4 to 6% per annum, and our current target's running at 5.5% at the moment over the last 5 years. And a more aggressive fund, which has got leverage, that is running at 7.5% over the last 2 years. It's a more recent fund. My personal background is I've been in trading fixed income products since the early 1990s, which takes me back to another time, another epoch, and maybe another currency I used to trade in with double-digit interest rates, and I've seen that right down to negative interest rates in the European space. We have a European-US focus in the approach, in the investment approach that we deploy in the funds that we have. And our background has been both sell and now buy side to try and bring together the best opportunities going forward.
Excellent. Thank you very much, Steve. Batting second, Arun, give us a little bit of background and how you're approaching fixed income. From what angle are you looking at it?
Certainly. Hi, Paul, and good afternoon. My name is Arun Kaul. I'm the president CIO of the Boutique CIO. Our focus is on providing outsourced CIO services to the advisor, investment advisor, independent advisor, community, family offices, and some smaller institutions. We offer both internal management as well as a manager's platform, as well as the full range of services in terms of strategy, design, manager research and due diligence, policy for investment advisors. My background is primarily on the CIO side, both on the asset management side, the hedge fund side, as well as from the asset allocation side, the consulting side, working with both advisors, private clients, as well as institutions, and fund to funds and some smaller banks and institutions and pension funds. So our approach overall is pretty broad, which I'm happy to go into later on. But we've been involved in multiple asset classes, and especially today are looking mostly at classes outside of fixed income, hybrid, if you will, for some of that 40 of the 60-40.
Excellent. Great. Thank you very much, Arun. And batting last, certainly not last, but batting third, Erik, if you can give us a little bit of background on and how you're looking at the financial markets and what your view, not your views, but the part of the fixed income world that you deal in.
Yeah, thank you very much. My name is Erik Herzfeld. I'm president and portfolio manager at Thomas J. Herzfeld Advisors. I've been with the firm for just over 12 years. At the firm, we build portfolios for clients in the 1940 Act products, mainly closed-end funds, focusing on capital preservation and quality of returns. Before I joined the firm, I was at JP Morgan, and I was working in the proprietary trading business and focusing on correlation opportunities in the FX derivatives market.
Excellent. Thank you very much. And Erik, we'll kind of go from bottom back up again. So now that we know the players, we got to know where their positions are. And so, Erik, what is your position and how are you looking at and approaching the fixed income market as it stands today?
Yeah. So at the firm, we believe that the inflationary pressures are going to be more lasting and permanent than transitory. So we've been, ever since the beginning, I would say, of the COVID crisis after March, April, we are positioning ourselves in pretty much the junkiest stuff you can imagine. We really felt that the Fed had everyone's backs and that they were going to go down this road of printing money and basically figuring out ways to forgive debt in some form. We took our cue from the GFC in 2008, and we basically learned a lot of lessons from that. And I think that it's been evident in terms of the response and policy that we've been seeing from really both administrations. So with that said, we've built our portfolios, as I mentioned, in lower credit and shorter duration, and then that's actually served us quite well.
Good, excellent. Arun, how do you look at today's markets in the fixed income world from where you're sitting, and where are you seeing some of the opportunities?
Right. Well, from an opportunity perspective, I think it's extremely limited. If we really step back and look at the last 10 or 20 years, it's a very, very difficult environment. It's an environment I think most investors don't want to be in. We're really reducing our allocation to the traditional fixed income. I agree with Erik's comments that where we've positioned ourselves in that space is on the shorter duration, lower credit quality space, but we have kept everything under 8 or 9 years in terms of maturity. So durations are 4 or 5 years in there, with traditional, mostly corporates and not a lot of treasury. But I think the backdrop is extremely negative. Obviously, rates are negative, real rates are negative and going to stay negative. And if the Fed wants inflation, eventually the Fed will have inflation. I think it's a very significant policy change that we have this cycle versus the 08-09 cycle. And transitory is transitory until it's no longer transitory. I think it's a very difficult arena to really manage. And if the Fed has stated their policy goal is to have more inflation, they're trying to manage from transitory to more inflation versus what used to be a 2% benchmark, I think will be a very difficult backdrop for them to navigate. So we're really looking at less traditional fixed income, and we're looking at adding hybrids, areas like preferred income potentially, and even a little bit of equity beta in some of the areas like mortgage REITs or REITs, or possibly even AMLPs and limited partnerships on the pipeline side to get some income. It is higher risk, but I think that's where we're being forced to go to get any kind of income.
Stephen, where do you look at, or how do you take a look at the fixed income world from where you sit in today's environment?
Well, we intervene in the subordinated space anyway, so we're already positioned in that lesser quality part of the fixed income world, but it's an exceedingly uncomfortable place to be, the fixed income market. The question is, when are rates going to go up and how much are they going to go up? There's been so much interest rate repression over the years. It's a difficult one to square. So for us, what we're trying to do is have a mixed bag of assets within the subordinated space. So we do have some floaters indexed on the short part of the curve, but also on the longer part of the curve, they're probably more sensitive to any potential interest rate hike going forward. We like fixed to floater bonds that will refix and take off the interest rate risk within 2, 3, 4, 5 years going forward. And it's important also for us to have assets showing a decent yield return, because there's that optionality of the interest rate return giving us a certain protection against maybe 1, 2, 3 points higher on the longer part of the curve going forward. So we have a mixed bag of assets and we play around with them. It's quite specific to the subordinated space to have fixed to floaters. You don't see that so much in the traditional credit side.
Okay, what's interesting to me, just in listening to the responses, and I'm going to kind of jump around here a little bit, but Arun, do you see the fixed income market continuing to be a good alternative to other assets that you may own in the portfolio? Because it sounds as though what I'm hearing from everybody is we need to take a decent amount of risk in the fixed income world. Is fixed income a good low correlated asset still to the equity markets or the rest of a diversified portfolio?
Yeah, I think that's a really good question. It's a very important question. So the answer is that I think in the intermediate space and the short space, the answer is still yes. There's no change from the portfolio perspective. And I think that's the greatest challenge. You really can't replace that component of it. I'd argue the longer dated maturities where we're beyond 10 to 20 years, arguably the risk there and the correlations will change. If we have rising rates, then you'll have less offset with the equity portfolio. But I think at least in the intermediate, that kind of 3 to 8 or 9 year maturity range, you can get the offset for equities and you need it. That's the challenge, is you really can't, it's very difficult to replace it. So we've sat in that space with at least 20 to 25% of the portfolio simply for that offset, even though we're getting tremendous push from the advisors and from the clients to raise the income. But there's nothing, very hard to replace that. You can step out into real estate and do it with real estate, but obviously then you have to give up the liquidity. So I think you have to maintain some of it in the portfolio. I think zero is just not the right place to be. But given that the yields are so low, you simply have to reduce your return expectation for that part of the portfolio. But I do think the diversification is still there in the intermediate and the shorter duration part.
Erik, you're looking a lot at the high yield space, and obviously high yield has been traditionally a area that correlates pretty well with the equity markets. How do you see the fixed income portfolio, and how do you see it playing as an offset to, again, a diversified portfolio? Does it still have a place, or do we have to look more equity-ish in our fixed income portfolios?
No, it's a really good point, Paul. I think one of the things that it's very important to keep in mind is really the trade between duration and credit quality. Duration is really where you need to keep that focus, because our thesis really is that inflation is going to be non-transitory and more permanent. And I think if you look at just obviously the money supply growth of 45, 50%, let's call it, in the last 5-6 months, it was 20% during the GFC. And the means in which we are delivering, redistributing, if you will, dropping money, like we discussed in 2008, the idea of this helicopter effect. Bernanke always talked about it. But in fact, it's actually better than the helicopter effect, because the helicopter effect means everybody gets the money, and obviously high, earners tend to just take that money and put it in their pocket. But now you're actually directly helicoptering it into the people that will most likely spend it. So this is something that we've embarked upon. It's going to continue. Just looking at the latest Cato Institute polling, 70% of Americans under 30 years old believe that the distribution of wealth is unjust. So this is a theme that is going to continue. And so the most important way to really look at that, and I think you need to stay away from anything with duration, anything with a very, very high quality AAA. It's just not going to keep up with the inflation, and you're locking yourself into a negative real rate of return. And I just do not see that as a good investment. So we've had a massive rally. If you look at CSI Bark, we're about 250 basis points trading rich to 10. That is extremely tight of our historical standards. And I really think that it's important to keep your duration very short and be nimble, and definitely have a large cash allocation to be able to take effect of choppiness in the market.
Steve, how about you? How do you take a look at the fixed income's role in a diversified portfolio with interest rates where we're at and some of the pressures that we're talking about here from an inflation perspective? Do we have to be equity-like, or can we still have a little bit more of a quote-unquote traditional fixed income portfolio to provide that low correlation to equities?
Thank you for that question. I think everybody's clear that the monetary policy is to generate real negative rates on the traditional fixed income part of the portfolio. So the question is, if that's over a short period of time, how much wealth destruction do you get? Or if that is more on a more permanent basis, and with what's just been said at the moment, how much of real negative rates are we going to go to? Are we really going to have -2, -3, -4 on the real rates? In which case, then basically you know what you're losing, and the idea is to go into the alternative space makes absolute sense. But before going there, you just have to be absolutely comfortable that you're leaving a certain comfort zone in terms of credit, and an enormous comfort zone in terms of liquidity if ever the scenarios going forward change quite dramatically. I don't think we can write anything in the sand as being gospel going forward. Things could change. So you are mechanically being pushed to go and get risk, look for risk in the fixed income part of the portfolio, look for risk in the dividend earning part of the equity side investment in order to generate a revenue which you may need to live off. But at the end of the day, you still need to keep in mind the balanced approach, the near cash approach, the quality that a treasury bond can give you relative to the types of investment we're intervening on, and keep that at the back of your mind. So I think the rebalancing is a must. The question is, how much does one rebalance onto more on the riskier side of the fixed income or the equity-like income generating products?
I wanted to just take a quick moment here before I go into some of the other questions that we've got. Please feel free to use the question and answer portion. I'll be monitoring that a little bit and kind of putting together some of the questions and aggregating some of those as we go forward. So we'll throw a few curveballs, again, staying with that baseball analogy. We'll throw maybe a few curveballs to our panelists here as we go through, and what's important to those of you that are watching / listening to the presentation. So in general, the view that it's coming through is that inflation may still become a problem, that I'm not getting a big buy-in that inflation is going to be transitory here, that it's going to be a little bit more permanent. How does inflation now start to impact your portfolio? And Erik, let me start with you on that one. One is, you had mentioned that you don't see it as transitory. It's going to be more permanent. And so how does that impact your strategy overall?
No, that's exactly right. I think as the rest of the panel, I do concur that you have to be a bit more alternative. The big trade-off that you have to make is the liquidity you're giving Are you willing to give the liquidity to get the return? And that means, looking at things that are tied up a bit more. Obviously, the non-transitory reason that I like to cite is that the Fed has quietly added a third mandate that they haven't really told everybody about. It's been whispered, and it's been, if you kind of look into when Powell, and the first time in history, goes on to Good Morning America, he's much more speaking to the public, not just speaking to Fed watchers and pundits. It added this third mandate of social inequality gap that he's spoken to many times about his drive-in on the way to work and seeing all the tents. So this third mandate is basically a longer term, let inflation run hotter, i.e. fix inflation. Obviously is going to help the less fortunate. And at the same token, is if you subsidize and go into this universal basic income Andrew Yang world, you can kind of help with the food inflation and so forth. So what will do well in a permanent type of, and then I'm not talking the 70s where you had double-digit inflation in 1979, 1980, nothing like that. But I do think that we're going to be in the permanent 5 to 6% camp. And that is obviously higher than 2.5% that the Fed guided us to. But I think that there is no way around it. So you have to basically start to really look at how to deploy and invest in a way that you're not going to get so damaged when the inflation does come.
Stephen, let me follow up with you because your comments too on inflation, I'm interested in here. And do you see inflation as being more permanent or transitory? And how do you invest in a world that we haven't seen now in 40 years?
It's quite an interesting observation that's just been made as to the rebalancing of wealth within an economy by generating inflation or modern monetary theory, i.e. permanent stimulus checks to support certain parts of the society. At the end of the day, inflation kills people who've got a fixed revenue, pensioners, those that do not have real assets, those that do not have access to leverage. So I don't see that as necessarily being socially an acceptable proposition over the long term. I understand the objective of inflation, i.e. to be able to support the quantity of debt within the system that is out of hand and totally imbalanced. And from that point of view, to be able to service that going forward, you do need some kind of inflation to help you out. But you also need real negative rates in order to be able to carry that going forward. So my take on the inflation is that we've had inflation anyway for the last 20 years. All my lifetime, I don't seem to have lived through a deflationary period at all. But there are certain factors that are pointing in the deflationary direction. First of all, we're very open economies, and there's a competitive disadvantage of having inflation in your economy relative to your competitor down the road from who you will be importing products going forward. Secondly, the demographics in the Western world are indicating that it's an aging population, and the consumption, the ways that individuals consume changes with that over time. So is there going to be the pent-up demand forever going forward? Now, you have the technology revolution. You can see what happened during the COVID crisis, that we're going very tech and less, or AI, and less with human intervention. So I can appreciate that we want to help people out forever and ever, but is that necessarily going to give us a permanent inflationary paradigm? And would that necessarily be socially acceptable going forward once people get to taste what inflation really is and the destruction of wealth it causes? Then I think the jury's a little bit still out for me on that one.
Arun, how do you take a look at inflation? Is it something that is transitory, as the Fed has indicated, or is it something that is going to be going away? And maybe to Stephen's point, we get into a more deflationary cycle after this transitory bout of inflation.
So a couple of comments, and I know there's a lot of big themes there, which I think you're going to touch on later. So I'll save some of the larger themes for later, but let me just say this to start. There's really three issues that are sort of rolled into this inflation discussion, where there's three issues to address. So one is the inflation. One is the fact that rates are just at such an absolute low. And then number three is really the fact that there's so much debt now in the system. So, and each of the three of them have different ramifications, obviously, in terms of how we think about the solutions. So we're not quite as negative on inflation running maybe as high as maybe some of the forecasts are, but we're certainly going to have it be higher than it has been before. Does it help rebalance wealth? I don't think so at all. So I agree with Steve's comments that it's 100% the wrong way to do it, or close to the wrong way to do it. The challenge really is that once you create the inflation, if you use rates to offset the inflation, which is how we would normally do it in whatever that textbook world was we grew up in the 80s and 90s, then your rising rates will do tremendous damage to an indebted economy. And that's the problem we have, is we don't have any room to maneuver now. So we're creating inflation, which is extremely negative given how low rates are, and also given how much debt there is in the system, because it's going to come out in the dollar. And that's really what you're left with in terms of rebalancing some of these issues. So I just don't think the policy is going to work. So we have negative rates, we have negative inflation, and clients at the moment, because it's 1% maybe, are not as sensitive to it. But I do agree, if we go to -2 and -3 and -4, then that's a serious issue. It does not rebalance wealth in any way. It just destroys wealth, and it forces you to really have to change your portfolio design dramatically. So it's the combination of the extremely low rate and the rising inflation and the higher debt that's really putting us in the bind that we're in. So if we had higher rates with rising inflation, then it would be a very different backdrop. But that's not where we are. So it's not like the 70s, it's not like the 80s. It's really very different from a lot of the historical periods that we're looking at, or at least trying to assess and say what kind of common ground or parallels do we have.
So let me follow up with you, Arun, on that exact point. Is one of the questions that was asked is, do you see, do the panelists see a significantly higher interest rate environment in the scenario that you've outlined? And significant, we're at roughly 1.5, 1.6 on a 10-year. Let's call it something north of 2.5 or 3 on the 10-year. Do we get to that level at some point, or are we mired in this kind of lower forever type of an environment? Arun, I'll let you start that one.
So I think we're stuck. We're in a really bad position, which is we cannot really afford to have significantly higher rates. So the solution that we want to have is to have some kind of real return after inflation. If the Fed lets the rate target go to 2.5 to 3, then historically the 10-year would be around 5.5, 5 to 5.5, at least a 200-point spread on average. There's a huge variance in real rates, but let's call it 200 points as a target. So that gets us to 500 points or 5% on the 10-year if inflation is 3. That's a pretty high number given the amount of debt that we have in the system. So the Fed can control the short end. The question really is, how long can they control the long end, and how much damage do they do by controlling or destroying the long end and holding it artificially low, especially if inflation is rising? And that's, I think, a whole different question. So the risk is that if rates do go higher, then you're going to have economic growth slow down, and you'll have multiples come in, certainly on the stock market, through traditional just discounted cash flow modeling. So higher rates should lead to lower stock values, and they should also lead to lower growth, simply given the amount of debt that we have in the system. And the natural growth is fairly low as it is, given population growth and demographics. So I just don't see a lot of room to maneuver in terms of the policy levers that are available, and the ones that are being utilized, I don't think are the best ones to utilize. So I just see us having less and less room to maneuver. I think it's different than 08-09. It's an important point. 08-09, we came in with the 10-year at around 3.5 to 4. and the Federal Reserve was not really targeting the long end as aggressively. Obviously, they targeted the short end for 6 years, right? It was 2015 before we got out of the zero mode, and we barely moved from there. We didn't get cash to be a real asset, cash that did not ever give a real return against inflation that entire cycle in the last 11 years, maybe for a year or so, but over the time period, really, it wasn't an asset from a real return perspective. And now we've done the same thing to the 10 years. So I think we're in a much smaller box, and it's going to be much harder to get out of.
Erik, how about you? Are we mired in this lower rate environment, or are we going to see significantly higher interest rates? And again, kind of using that 3% plus on the 10-year as significant. Do you see that occurring, and what are the implications if indeed we get there?
Right. Well, I think Arun makes a really good point, and his point is that the policy decisions, they're not the right ones to address the inequality, and I completely agree with him. But that's exactly the thing: is that these are going to be policy missteps, and there's going to be the results of them. And if you believe in the third mandate, which is what I believe in, there's no way that you can avoid inflation, because you're effectively going to do. This is our fourth stimulus check going out. Remember, when we started food stamps, it was supposed to be to get people back on their feet after 60, 90 days. Food stamps has become a permanent thing for many families that are on it for years and years. Once you get a taste for stimulus checks, and as you know, 25% of it is spent right away. The remaining is to pay down debt and do a little saving. But these checks are going to become more permanent. They're going to keep coming, and money's going to keep getting spent. So you're going to see inflation. Now, the big difference is in other examples of high debt to GDP economies, such as Japan, they had a currency that in the 1970s was 350 yen to the dollar. Now it's closer to 100, 109. That's extremely deflationary. So they had a massive deflationary effect in Japan, which basically kept inflation from creeping up. We do not have that. Look at Bitcoin, look at NFTs. This is something that's the effect of the dollar over time will lose its strong policy. And if you look 5 to 10 years down the road, once you get a dollar that starts to lose value against everything else, you will get inflation just from that. Once you get the redistribution. And one of the things they can do is they can tax. That's a big proposal, upper end bracket. They'll tax a lot and redistribute. But if you do believe in the third mandate, there's no other way that it's impossible not to see inflation, in my opinion.
Steve, how about you? Are we going to see significantly higher interest rates? Are we going to see something north of 3, or are we kind of mired in this lower for longer type of interest rate environment?
Aside from maybe policy mistakes, I think we're going down the more Japanese road. And the thing I'd say about this is 2018, we saw rates creep up over the 3% mark, and that had a destabilizing effect on the equity and credit markets at that time. And that's a very sort of recent movement. We have today even more debt in the system. So I think maybe that threshold is possibly slightly lower. The second point is the quantity of debt that has to be funded for the federal government. That means deficits, and especially if they are throwing out stimulus checks every 5 minutes, if rates go up for them, then we might even have a sort of crowding out effect coming from the federal government, that needs so much money that will bid up in terms of rates, and might end up pushing rates beyond what the Fed would necessarily want to do. Or on the other hand, the Fed might be required to intervene in terms of QE to stabilize rates, which would be a counterproductive move of raising rates in the first place. So you would have, on the one hand, the idea of rates going up, and on the other hand, you would be buying the treasuries in order to keep them at a low price. So all of this is not very clear going forward. The final point, and that's something I'll put my European hat on here, is that you've got to keep in mind that the rest of the world, especially Europe and Japan, have got negative rates. And if rates start going up too high, it just attracts hot money back to the US because it's showing a positive print. And so you could have an imbalances coming from that money flow, imbalances linked to the emerging market space, borrowing in US dollars at higher rates with a higher dollar and higher rates going forward. This could be quite unstabilizing going forward. So I think there's a lot of moving parts. And as Arun just said, they're between a rock and a hard place on this one. It's going to be exceedingly tricky to play this wicket.
Well, Steve, since you make that reference, I'll go back to my old college disc jockey days and reference the vapors turning Japanese. With the debt that we're seeing, not only in the US, and we're talking about a huge amount of US debt, but we also have a large quantity of debt in Europe, large quantity of debt in Japan. And there are negative rates now, first in Japan, then Europe. Is the US going down that road? Do we wind up in a negative interest rate environment? And what are the impacts then on the debt load globally? Let's step outside the US for a second, but the debt load globally in that type of an environment.
Okay, as far as negative rates are concerned, we have them already. They're called negative real rates. When you target a 2% inflation target with a 0% Fed funds, that clearly shows that you are looking for real negative yields. Now, as far as nominal rates going negative in the US, that's a bit of a tricky one because we're talking about a lot of pools of in dollar amounts, treasuries held as reserves in different parts of the world. If that goes negative, it's possible that we could have some offloading taking place by those hands going forward, and that could have a destabilizing effect. So then the question arises about the reserve status of the US dollar going forward. So I think if the nominal rates are positive and the real rates are negative, the Fed's happy with that. That's a situation we've been carrying since 2009 anyway.
Arun, how do you take a look at that situation? Are we destined to go down the negative interest rate road after this maybe a little bout of higher rates? And what are the impacts then globally for essentially a zero or negative rate environment around the world? How do you view that through your lens?
I would say that the US simply can't go negative. I think if you look at the economic the totality of the global system, certain countries can go negative, but the whole system can't go negative. Negative makes no sense. If you stand up and try and explain what negative rates are from a textbook or a theory perspective, I don't have any way to try and explain it. It doesn't make any sense. So Europe can be negative, or a smaller country can be negative in the totality of the system, given that they have choices that are positive. If the whole system is negative, Europe is negative, if the US is negative with Europe and Japan, I don't understand how any of that would function. It's effectively expropriating capital from people's accounts, which would completely disabuse the whole notion of cash. So I don't think the US goes negative simply because the system just wouldn't be able to withstand it. But I wanted to just comment on a couple of comments that Erik and Steve made before, I think that are really important. The hot money one, I think, is a big one that Steve mentioned. The hot money is simply going to go from area to area to area in response to policy decisions. Wherever there's an opportunity, the hot money is going to go. It's going to go very quickly, which to some degree will negate some of the policy levers. And then from a rebalancing perspective, it makes it very hard to rebalance if you're trying to rebalance the overall wealth, as Erik is referring to, with hot money. But also to Erik's comments as well, I think it's important to note that if we're going to have inflation, and it's generally going to come from the commodity space, that redistributes the wealth amongst countries much more so than within countries. So if we go back to 2000, 2008, which was a commodity cycle, the wealth went from the US to the commodity countries, which were Russia and Brazil and the Middle East and Canada and Australia. And it came in the form of a lower US dollar and higher currency values for all of those countries. So you basically debase the value of the US by creating that run in commodities if it's going to come from inflation. So I think the rebalancing is more prevalent globally than inside the country. And then in terms of inflation and negative rates and so on, if we do see more pressure or lower nominal rates, then we're already seeing inflation. It's sitting right in front of us inside crypto. And we can define that however we want, but the two most important terms I think are one, A, it's a store of value, or B, it's a collectible. If it's a store of value like gold, then money sits there simply to prevent it from being taken out of our bank account or from a negative rate. And gold, which theoretically has some value, has some use, is really more of a store of value. No interest rate, no return on capital, but it has a very long history of being a store of value. So we've now created crypto, which I think acts as a store of value, and those assets will go up in price if we stay low on the nominal side and negative. And of course, if we end up going negative on the actual number, then those values go up even further, whether that's inflationary or commodity based or crypto based. You'll see all those asset prices, I think, react to policy that right now doesn't make a lot of sense and potentially could make less sense if we keep on this road going forward.
Yeah, Arun, you covered a ton of areas and hit a couple of key points. But Erik, I want to come back to you on the question of negative interest rates. Again, are we following the policies of Europe, of Japan? Japan certainly the front end of that train, if you will, and the US maybe the back end still holding on to positive rates. Do we go down that road with the rest of the world? And what are those impacts on the global debt situation with a potential for negative rates?
Yeah, that's really the big question. And I agree with Arun and Steve. I don't see negative real rates. I don't see that in the U.S. If you believe in the American exceptionalism that we've experienced for the last 3-4 decades, this would tell you that we're definitely not going to go down that culturally, as well as it's just mentally probably the most depressing thing is to have that situation which Japan has gone through. I think one of the key things to kind of unpack, Arun said a lot of very interesting things. And one of the things I think that is that Japan, they have obviously 250% debt to GDP. It's been increasing for years, but it's domestically controlled. In other words, there's no balance of payment, foreign exchange implications. The U.S. has that major problem, is that it literally all of our debt, as you're aware, is owned. Besides Japan and China, Fed, it has a balance of payment, and it has a FX implication. And I do see that this move into anything with value, call it what you will, classic cars all the way, Bitcoin, NFTs. It's basically this where do I get this inflation hedge? Where do I get out of the dollar? And how do I protect my assets? I think that this is going to continue. This theme will continue, and I just do not see the dollar contributing to any type of gains in the future. I think once the dollar starts to slip, it'll become a very, very scary snowball. And the question really is what's it going to slip against, right? And I think that's really not necessarily against fiat currencies, but towards other type of non-fiat currencies. That's something that the Fed and just policymakers in general have to be really careful of addressing.
Arun, you made a comment that was interesting to me, having taught business school as well, as to how you explain negative interest rates to your class. We've all had the same type of question recently. How do you explain modern monetary theory? But it seems to me that it's already been kind of embraced by the Fed, by central banks around the world. What do you think are the impacts if we have a ready buyer of treasuries and they're not a buyer at price, but a buyer at any price? What are the impacts, do you think, of that type of policy where the Fed pretty much stands to be the buyer at all recourse?
Well, I would just label it the great distortion. And the system simply doesn't work. So the system that we have is not designed to have the Federal Reserve buy all assets that are effectively a massive statement of malinvestment. So what you have the Fed doing is buying all of these assets because no one else wants to buy them or because the price isn't right. So you start, I think, with the concept of price discovery. Everything we have is predicated on the notion of appropriate price discovery for assets. Can we sometimes be off? Of course, but we're completely off. And that's the problem. The distortion is so large that it's impacting other asset classes. So if we go back to 1999, we had this massive bubble in equities. Prices for other categories weren't dramatically off, so we were able to reset fairly quickly. Not to say it wasn't damaging for equities, but real estate and cash and bonds weren't really mispriced. Today, we have a lot of mispricing. So I think if the question is what are the impacts of the Fed doing, it's a massive distortion to the system. It interferes with price discovery, and investors know that, which makes everything much less stable because it only works until policy changes, and then you have to adjust what you're doing on the investment side to different policy from the central banks. And just to answer your previous question, if I didn't maybe answer it directly, with negative rates in Europe and Japan are a sign of weakness. They're not strong enough to have real rates to grow their economy. It's a sign of low growth. So the US is now adopting some of these policies because there's not enough growth. There's not enough growth in our economy to satisfy some of the some of the mandates that, as Erik was talking about, third mandates and so on. So to answer the question, it interferes with price discovery. It creates distortions. The longer those distortions go on, the more meaningfully incorrect investment is, the worse prices are, and the worse decisions get made in the overall system. And that's the risk that we have with some of these crypto assets and other assets being mispriced, is you get a lot of malinvestment, which I think is where we're heading.
Steve, how do you take a look at the notion that the Fed and the ECB and certainly the Bank of Japan kind of stand as the buyer of any recourse, buyer at any price, and the impact on those markets, that we don't have to worry about the markets being fair, normal, et cetera, because the Fed is always going to be there. What are your views on the Fed interaction within the markets?
Paul, before addressing that, I'd just like to add to what's just been mentioned, that by going down the negative interest rate road, I'm talking about nominal rates going negative, you are also destroying the banking sector and zombifying that part of the credit system, which means to say that in a highly indebted economy like the US, how does that go forward? How do you reorganize yourself going forward with that kind of situation facing you? So I'd just like to say that. Now, as far as the repression of or the intervention of the central bankers and forcing investors down the risk road, is that you are really taking a certain comfort investment zone and putting people in an exceedingly uncomfortable area in which a lot of them don't really know what they're doing. And to give you an example, on the subordinated investment space, there are instruments called Contingent Convertible bonds, or COCOs. As these bonds in the European space were yielding 4 or 5 times more than the traditional investment, many unstable hands or weak hands came into the market. And the first problem that arose, those bonds were off 20 points in a week, when they're making 5% in a year. So that's the risk, is that you are pushing people in areas that don't really know where they're going. They don't have the tools to monitor the risk. They're going in volume when these are more niche markets that you have to be, and this is the point Erik mentioned right at the beginning, nimble to trade in and out to avoid getting sucked in the risk vortex. So that's what this kind of investment repression does to investors. And you have pension funds that will be struggling, because how many hits can you take before it starts showing up on the other side of the balance sheet equation, and the pensioners that are looking to get something out of the fund they've invested in for years. So this is the problem with this kind of intervention, misallocation of resources, interest rates too low, overcapacity, bank lending for zombifying of the banking system in the negative yielding, in negative nominal rate world like Europe. It doesn't solve anything. It just makes the problem worse, to be honest.
Erik, how do you take a look at the Fed involvement in the markets here? And do you see that we're essentially going down that monetary theory road? And what do you think are going to be the long-term impacts of the central bank intervention?
Yeah, no, I agree with Arun and Steve completely with regard to, we are in this environment that, it really depends on if you believe, that one of the things that has served the Fed well for decades is that it was well understood about their mandates, price stability and full employment. This third mandate, as I keep mentioning, it's an observation. It feels like it's something that the Fed has been looking to achieve for years, and now they have a green light to do so. It really depends if this third mandate is going to really become the next 30 years or just the next 4 years. So when the Fed goes back and believes that it's transitory, it doesn't really jive with my thoughts that it's more of a permanent mandate, because if they really believe it's a permanent mandate, you're going to have more inflation. Now, I think the thing that I want to go back to about inflation itself is not a bad thing. It's the change in inflation. In other words, the return. Think of it as a log return of inflation. If inflation is always 5% forever, there's no volatility in inflation. It's just everything goes 5%. The problem was we had in the 70s was it went from 4% to 12, 13%, and the rate of change was too great. So if the Fed can manage this change and slowly steer towards a 4 or 5% rate of inflation, that's a lot different than a spike to 5% and slam on the brakes. So it really depends on how well they can manage it. It's the great experiment, so to speak. I think Arun's bang on. I think that the Fed has distorted asset prices. There's no doubt about it. But I do think that that's in their them trying to achieve this 2.5% rate of inflation, which they really have never ever ran against, or in other words, hit a sustainable inflation to that extent. But I will say this: we've never experienced this type of money stock growth and this type of low inflation ever before. I think that gap will reckon, and the velocity of money, as I alluded to earlier, which is everything that Japan never had, which led to the zombification of banks. We do not have a velocity problem. I'm based in Miami Beach. Come down to Miami and you will see the velocity of money firsthand.
I wanted to follow up real quick, and if everybody can take just maybe a minute or so, and we'll wrap up here immediately. So we're bumping up against the end. So if you could keep your answer short, and of course it's going to be a long question, but demographics and the aging of the Western civilizations, this is a question from the audience, inherently is deflationary. So how do you square that with, Erik, I'll start with you, the inflationary topic that you're talking about. Is that truly deflationary, and how do you see that play out over time?
Right. No, that's exactly it. I mean, Italy, Germany, the U.S. I mean, we are definitely in an aging society. Japan, probably, being number one, and then Europe being number two. So you're absolutely right. And I think that not everything is going to be inflationary. That's one of the things that's deflationary. But you're going to have the offsetting weakness in the dollar, which is inflationary. You're going to have tax, large tax hits to the upper wealthy. That's being discussed. That's going to be deflationary. So you have these different forces that are going to be at play, which plays to the Fed's advantage. They can kind of play with this fiscal and this fiscal backdrop, and they can sculpt their policy accordingly. And that was probably the hardest thing that they could not do in the last administration, which they can do now.
Arun, how do you take a look at the demographics and aging of the societies in general as a deflationary force in the context that we're talking about here?
So I don't see the demographics themselves as being deflationary per se. They lead to lower growth because we have slower population growth. And that's really on the demand side. So yes, it's lower growth. Ultimately, the deflationary or the savings in price comes from the supply side, which is business, productivity, and innovation. And what we're seeing right now is a tremendous amount of capacity and productivity and innovation from certain sectors or segments of the economy. And the deflation that we're experiencing is coming from some of those areas. The deflation is really largely positive. It's never presented that way, but it's extremely positive because it creates affordability of product. It lowers product pricing curves, and it gives everyone affordability, ability to have access to these goods and services. So ultimately, the demographics just lead to slower growth because we have less demand. It doesn't drive innovation and research and supply, which is independent from population growth. And it's mostly coming from the other side, not the population growth in the Western world, because we've had lower rates for a while now.
How about you, Steve? How do you come in on the demographics and aging population as far as being a deflationary force, offsetting some of the inflation that we're seeing here?
I agree with what's just been said. As I mentioned earlier on, I think this the deflationary demographic paradigm is an underlying theme that's going to accompany us for the next 30 years, and that is going to get basically stronger as the baby boom and then Generation X start to retire. I'll just add one point, because what's been said has been spot on, is that if you are dependent on retirement income going forward, and you have interest rate repression, interest rate nominal rates being so low or negative rates in Europe, you basically have to save more in order to live off the capital that you're trying to put aside for your later years, which in fact takes off the table consumption that could have been there in a normal time with normal interest rate situation going forward. So there's also that aspect of the behavior of individuals going forward. So it's undeniable that we are going into this is a strong deflationary force in the equation to take account of.
Steve, great. I appreciate it. You get the last word. I want to thank the panelists, Arun, Erik, Stephen. It's been a great hour of conversation discussing the interest rate environment, inflation, how best to look at fixed income in our brave new world, as it were. I want to thank everybody that participated, the questions that came in, tried to get to as many as I could. With that, Michael, I'll turn it back to you, and I appreciate everybody's time and attention. And if other questions, please feel free to email them in. We'll send them around to the panelists.
All right. Thank you, Paul.
Thank you.
Thank you, Stephen, Erik, Arun. Thank you. It was a very interesting panel. It'll be interesting to see who's right, who's wrong. There was a little bit of controversy here. So I appreciate you guys. Very well thought out, very well prepared, very insightful. Thank you.
Thank you very much.
Thank you.
My pleasure. Thank you, Michael, for organizing. Thank you,
with you.
Paul, for overseeing this debate.
Take care, everyone.
All right, take care. So anyway, this is the last and final presentation of the day. So for all of you that attended, thank you very much. Thank you to our sponsors and our members of FLIA for providing us with the opportunity to host these events. And this concludes the session. We will be sending out a copy of the videos tomorrow, and you can take a look at it on the FLIA website under past events. So please check there. If you want content and the speaker is willing to share their content with you, it'll be uploaded onto the site. the registration page becomes the follow-up page. But again, you can find it all through events.flyer.org. If you want to speak to people, you can contact them directly through the platform. And as you can imagine, I get a lot of requests to make connections, so we automated that function. So please use the platform to handle any of that stuff. Our next event, Real Estate Direct Lending Private Debt Forum, will be happening on June 24th from 10 to 4, 10 a.m. Eastern time to 4 p.m. So if you haven't registered, please register to do so. And that concludes our event today. Thank you all very much for participating. Have a great day. Bye now.